This is Wall Street Week. I'm David Weston, bringing you stories of capitalism. President Trump wants to build what he calls a golden fleet to transform the U.S. Navy. What will it take to get it done? Are U.S. shipbuilders up to the task? And can the government stay the course this time? Plus, it's one thing to charge $166 billion in tariffs. It's quite another to give it all back. The continuing saga of President Trump's IEEPA tariffs and whether Humpty Dumpty can ever really be put back together again. And Blair Effron of Centerview Partners takes us through what the AI rush is doing to American companies and the deals they are trying to make. Is there anything left for the rest of us? But we start with the global concern over inflation in a week that gave us new CPI numbers and Chair Warsh's first testimony on Capitol Hill. Are we facing higher long-term interest rates? How much of it comes from that AI rush? And what does it mean for Western economies if we can't get back to that magical 2% target? Loretta Mester was president of the Federal Reserve Bank of Cleveland and now holds positions at both Penn's Wharton School and Princeton. We got new inflation numbers out this week, which were not as bad as they had been in the past. But there has been a growing concern, I think, about longer-term inflation. Where are we?
Well, inflation's been above the 2% goal of the Fed for over 5 years, so we do have an inflation problem. I think it remains to be seen whether where interest rates are today are enough, right, to actually move inflation back down. I think the question that FOMC is going to have to ask itself is, do we need to raise interest rates a bit in order to add restrictiveness to the economy to bring inflation down? And I think they don't know that yet. I think the tone is getting more that we're impatient with this inflation, but I think they're going to wait for some more data before they make up their mind that they're going to need to raise rates. I think there's a good case for saying we need higher interest rates because it's hard to argue that where we are today is very restrictive on the economy.
And particularly maybe because the headline number came down really largely because of fuel. Really,
yeah, that's right. I would say, though, that overall the report was a pretty good report, even when you look at the components. I mean, one of the things that have been, I think, troubling me is if you look at core services, excluding housing, and I think that's a key indicator to look at, that's been moving up, right? We had the inflation coming down last year. Even before the war in Iran, we saw that indicator, the services component, excluding housing, starting to move back up. And I think that's got to be a concern for the FOMC. You know, they've been forecasting inflation is going to come down, and even without oil prices pushing it back up, you still see that inflation's been pretty sticky.
And so it raises the question for some of us, why? I mean, it's good to have the numbers and know where the numbers are, but then you want to know what is really driving that because you have some sense of where it's going to go next.
Well, I think that's the question about how restrictive really is policy, right? Monetary policy is what's going to determine whether demand is outpacing supply and therefore putting upward pressure on prices, or, right, whether it's restricted enough and it's going to bring demand more into balance with supply.
The one place where we know demand is up is in AI and all that comes with it. All the investments being made are really, to me at least, stunning. Does that in and of itself suggest that we probably are going to have continued inflation pressure for the foreseeable future?
Well, you certainly see prices for components that go into AI being elevated, and that is a source of pressure, upward pressure on inflation. I think the question, and this is something that the new chair, Kevin Warsh, has been talking about, is eventually he believes that AI will increase productivity enough that it becomes sort of a disinflationary force. I don't think the timing really suggests that we're going to get there soon. I do think right now it's an inflationary issue, and the question is how long will that last, and whether, again, that'll feed into other parts of the inflation and the consumption basket and therefore become a more of a broader inflation problem.
And this week we had not just the CPI numbers, but also Chair Warsh with his first appearance on Capitol Hill, where, to my hearing, said we really are serious about this inflation. And he recognized what you said, which is we've had it over 2% for a long time now. We've got to do something about that. At the same time, maybe, as you said, eventually it might come back down. How does he balance those two things? And how long is eventually?
Well, this is always a question for the Fed. And certainly, I think it was great that he reiterated the commitment that the FOMC and the Fed has to 2% price stability. I would say, as someone who was at the Fed, right, we were always committed to the 2% inflation target. That's not, and price stability and maximum employment, which are the goals that we've been given by Congress. So that isn't new. And the real question is, in making those trade-offs between the two goals, when there are trade-offs, right, and I think they're going to have to take seriously whether their policy rate right now is in the right place or whether they're going to have to recalibrate that a bit higher to get inflation down.
As you say, there's a dual mandate. It's both about price stability as well as employment. Does the nature of the employment situation in the United States right now actually give the Fed, if they wanted to use it, some room to raise rates some?
Well, you know, if you look at the labor market, it's an interesting labor market in the sense that it does appear to be pretty steady and in balance. I think what troubles people is when you look at the rate of payroll employment growth, it's much slower than it had been in the past, right? It used to be that you'd say to keep the unemployment rate stable, you would need 150,000 jobs added per month. Now, right, that number is much lower, right? Many estimates are between 50 and 70,000 a month. So that's quite a bit lower. And that's because the supply side of the labor market has changed so much. So you don't need as much hiring to keep supply and demand in balance. So there's a lot of concern about the labor market in terms of those lower growth numbers, but actually it's been a pretty stable, and the unemployment rate itself is low. That doesn't mean that there aren't problems in the labor market in terms of different aspects of it. As probably you know from, and your listeners know, right, young college graduates have had to struggle to get jobs. Part of it may be AI, part of it may be uncertainty about the economy, but a lot of what's happening in the labor market is on the supply side, not on the demand side. And so yes, if the key concern right now in the economy is the inflation part of the mandate, not the labor side.
You mentioned the various task force, 5 I think there are, that Chair Warsh has named to deal with various aspects. I suppose it's sort of to be expected that when somebody comes in, they want to take a fresh look at things. Were you surprised at how quickly and how extensively he's looking at some basic things at the Fed?
Well, not really, because, you know, he was very vocal before he became chair about some of the things that he thought could be rethought. Right, and so if you look at the task force, there's one on communications, there's one on the balance sheet, and he's been very vocal about the balance sheet and the use of quantitative easing. He's been very vocal about trying to find data sources that are more micro-oriented data sources and more forward-looking to help the Fed do its projections so that it can have a better sense of where the economy is going. And the last one, of course, we just talked about AI, the labor market. And he has particular views on that. What I was happy to see is that the people he's chosen as leaders of those 5 areas, they really are experts. You know, it's a combination of academics, central bankers, not only U.S. central bankers but abroad, who have been central banking experience in terms of actually doing monetary policy, and some business leaders. So I think the combination of those people, right, and with the staff help from the Fed, as he said, right, I think we're going to get some very thoughtful results from that. And of course, then the FOMC will have to take up some of those recommendations and debate them among themselves because they are the policymakers.
Recently, the projections based on the markets have changed a fair amount about the likelihood of a rate increase. For example, in July, it really has moved around a lot. You've dealt with this for a long time. Is that typical? Have you seen that before? Is this unusual that the expectations are changing fairly rapidly?
Well, I think the economy has been changing, right? It's hard to read an economy where you had the tariff shock, right? Then we had the Iran war and the oil price shock. So there's a lot of uncertainty about what the trajectory of the economy is going to be. And of course, the on again, off again, you know, Iran war, the ceasefire, right? That adds to sort of uncertainty because oil prices are a significant input into a lot of parts of the economy. So I'm not sure that I would say that it's more volatility than what should be expected given the uncertainty we've been facing in the economy. And then layered on top of that, of course, you have a new Fed chair coming in.
As you say, for several years now, we've had an inflation problem. And one question is, will it solve itself, or do they have to get more restrictive? But from your perspective, do you think that the degree of that problem has changed over the last 6 months, 9 months? Is it a bigger problem today than it was 6 months ago?
I think it's a different problem, right? I think 6 months ago, the focus was on how much of the tariffs were going to feed through to inflation. And remember, there was also some concern on some of the committee members, right, about the labor market. I think the labor market is stabilized, and I think they have a much better view of sort of the low payroll numbers, not necessarily meaning the labor market is weakening appreciably. I think there's recognition now that probably the tariff part of the inflation story is stabilized, right? There's not going to be much more pass-through of that. We do have the oil price shock now, which is a new shock. But I think there's more recognition of the accumulation of bad readings in terms of inflation moving in the wrong direction, that I think that's really what's changed the narrative about inflation. I think there's better recognition that even though we're hoping that we're at a point where interest rates are enough to get inflation back down to 2%, that projection may not come to pass. And I think that's what's changed.
Coming up, we go to Pascagoula, Mississippi to see firsthand what it will take for President Trump to get all those ships he needs for his so-called Golden Fleet. This is a story about staying the course. As America marks 250 years of independence, President Trump has plans for a much bigger Navy, what he calls a Golden Fleet. But to get from planning to doing requires more than just money. It requires workers, suppliers, shipyards, design discipline, and executing on the plan over the course of years, even as the very nature of naval combat faces disruption. Bloomberg's Scarlett Fu has the story.
This is an America-class amphibious assault ship currently under construction for the U.S. Navy by Huntington Ingalls Industries, also known as HII.
So we're the flight deck of LHA-8, which is really the ship that takes Marines into the fight. This deck will have between 12 and 20 F-35s based on the configuration.
They park here?
Yeah, so it's a very capable ship. It's gonna go to trials the end of this year and deliver next year.
It's just one of several complex naval ships being built at the Ingalls shipyard in Pascagoula, Mississippi, where we got a tour from HII CEO Christopher Kastner.
Shipbuilding gets in your blood. There's just something so rewarding about building a ship you know is going to go into service.
Turning this steel into American naval power takes thousands of workers, millions of parts, and years of labor. Under President Donald Trump, Washington wants more ships fast.
I have approved a plan for the Navy to begin the construction of two brand new, very large, the largest we've ever built, battleships. They'll be the fastest, the biggest, and by far 100 times more powerful than any battleship ever built.
His administration's plan calls for new combatants, auxiliaries, unmanned vessels, and a nuclear-powered battleship. Currently, the U.S. Navy operates roughly 290 battle force ships, well below the mandated 355 ships. The Navy is requesting $65.8 billion for their 2027 fiscal year. That's about $18 billion, or almost 40% more than it requested for 2026. For shipbuilders, that translates into years of expected revenue.
The administration is investing in the right places. There's a lot of momentum behind shipbuilding. We see improvements across both of our shipyards, and we need to continue to improve to support their requirements.
Momentum aside, can the industry build a fleet at the speed and scale that this White House wants, especially when construction of the most complex Navy vessels is split between two big players, General Dynamics and HII?
HII provides 50% of the ships in the United States fleet. We build nuclear vessels, aircraft carriers, and submarines in Newport News, Virginia, and then we build 4 classes of surface combatants here.
One of the biggest limitations is labor. Shipbuilding depends on skilled workers, like welders, electricians, and pipe fitters. Today, more than a quarter of these maritime workers are approaching retirement age, which is a problem, according to Seamus Daniels of the Center for Strategic and International Studies.
A major constraint is definitely the workforce challenge, as shipyards are losing some of their more experienced workers, and they're being replaced by workers who have less experience. So ultimately, that may contribute to some of the delays that the Navy is seeing in producing ships as you're trying to train this workforce and really get them up to speed.
Again, I'm missing my 45 here. What's the takeout for that, Ned?
To fill that gap, the Navy helps fund workforce initiatives, while shipbuilders develop their own pipelines. Both General Dynamics and HII have apprenticeship programs. HII's yard in Mississippi employs more than 11,000 people, making it one of the state's largest manufacturing employers.
In this building at the MTA, we also teach sheet metal, joiners, pipe and hull insulators, and also a lot of electrician training. Being able to give some knowledge to them so that way they can take it with them out into the yard and better their career and also the company as well.
The selling point for trainees are paid training, a path to higher wages, and a career that does not always require a 4-year college degree. Solving for a steady stream of skilled laborers is not the only challenge. The industry also needs to address supply chain issues, on-time contracts, design changes, and overall bureaucracy, and that is after the money has come through.
We need to get funding on time to get the suppliers started. What we're doing is working through a backlog that was put in place under really difficult conditions and under a different economic environment. Our 2 largest contracts were executed in 2019. And you think about what was going on in 2019, no inflation, a more stable supply base, and those were put under contract, then COVID hit. And so we had the supply chain impacted, labor impacted, made it very challenging. So we're working through those. But the ships that are being put under contract now are putting under contract and schedule performance and schedule predictability, assuming what the supply chain can do right now, assuming the constraints we have in our shipyard.
If you were advising policymakers, lawmakers, the Navy, what would be one policy recommendation that would increase U.S. ship output?
Yeah, be on time, make sure the funding arrives on time, make sure the supply chain is safe and can meet the requirements, and we don't get behind before we start. That happens from time to time in shipbuilding, where you get late orders, they hold the schedule consistent with what the initial contract said, you have no chance to meet it.
Securing funding is just the beginning. There's also the sequence of how the money, contracts, and ship designs move through the system.
Government shutdowns are a major hindrance to actual effective shipbuilding and making sure that contracts and programs themselves are getting started. But I think there's a broader issue beyond the appropriations and funding process that comes down to the way that the Navy designs its ships as well. And this is about the requirements process that the Navy goes through. U.S. naval vessels are incredibly complex with combat systems, radar, and other technology. And so that means that the ships themselves and their designs are incredibly complex. But given the timelines it takes to design and build these, the requirements may evolve as the threat environment evolves over time. What that ultimately means is that the Navy may start constructing ships before the design is finalized. And that can be a major issue, especially when you're changing the design as you're building the ship.
Every time we change a requirement, change a design, it costs us a lot, both in dollars as well as in schedule. So that's got to stop.
There isn't a day that I go to work that I'm not thinking about what's going on here and in other places around the world where you're serving.
Retired Navy Admiral Mike Mullen served as Chief of Naval Operations under President George W. Bush and Chairman of the Joint Chiefs of Staff in the first few years of the Obama administration.
I think the biggest challenge that the Trump administration is going to have is execution and staying, within budget and staying on schedule and holding people accountable. So I think all the pieces are there. Now the question is, can we execute?
One solution, farm out the work. Today, only 1/10 of Navy shipbuilding is done at distributed sites. The Navy wants to increase that to half by using qualified suppliers and smaller yards across the country to add capacity.
We doubled our outsource capacity last year, another 30% this year, and we'll continue to increase that as the partners get qualified. We're very careful to do it correctly, because if you don't do it correctly, there's significant challenges with quality and schedule performance. So you have to be mindful with how you do it, but we will continue to outsource.
That plan also relies on building ships differently, using more modular digital designs that can be spread out across multiple yards.
So this is thinking through how to design ships and submarines in a way that different parts, different major segments of the ship can be constructed in different parts of the country, and then they can be combined in one major shipyard. But what that'll ultimately allow the U.S. to do is to leverage areas in smaller, potentially commercial shipyards or repair yards that can focus on these modules, so then they can be combined. And what that would ultimately mean is being able to distribute shipbuilding need and capacity across other areas of the country.
Then there's the contrast with how our global peers are building ships. China is achieving scale through a vast commercial and naval shipbuilding base, while South Korea and Japan are setting standards for their speed, process discipline, and production capacity of commercial ships.
I think it's good to always compare yourself against the competition. There are different shipbuilding processes. Commercial ships are completely different from building a defense ship. If you were to go into a Korean shipyard for commercial, it looks very different than this shipyard here. But if you go into the defense shipyard, it looks very similar to this. Actually, their defense shipyards look more alike than ours in their commercial shipyard. So I think it's a good comparison. You always need to know what the competition is doing.
China's shipbuilding surge is a big reason U.S. yards expect demand to stay elevated for years.
I think the growth in China and the growth in their shipbuilding programs means that we're going to be building ships for a while here, and we need to continue to build.
We need to concentrate on that because China's building a big fleet. And while China's fleet is significant in numbers, they've got a ways to go from a quality standpoint, and we need to pay attention to that as well.
Even if America can build more ships, another question hangs over the fleet. What kinds of ships should be built? The ongoing conflicts in Ukraine and the Middle East make clear how relatively cheap drones and missiles can threaten expensive traditional vessels.
I think what the Navy needs to pursue is what is generally referred to as a high-low mix of capabilities. So having your larger vessels that can perform exquisite tasks that are large and maybe expensive in some cases, and combining those with cheaper, more affordable forces that provide a different sort of effects, but you can actually buy them in mass.
In the Red Sea for literally months on end, we were shooting down cheap drones with very expensive missiles, which is a losing game in the long run. But we were able to protect the ships. We know this is coming out there in terms of the drones.
There's also the risk to the Marines on board these ships. To reduce that danger and extend the fleet's reach, the Navy is investing in autonomous, uncrewed vessels.
We have a Romulus family of systems for surface vehicles. So we saw it coming. It's really a force multiplier. It leads into their strategy or their hedge strategy where they have manned and unmanned ships working together. And they've had that strategy for a while. The technology just hasn't been there to support it. Now the technology has. The autonomy technology has come into the place where the ships are more reliable and the integration between manned and unmanned is more reliable.
But can the Navy learn from past mistakes and implement real changes to improve future fleets and sea warfare?
What do companies like HII need from the government to be the premier shipbuilder?
We just need predictable orders. We need a chance to be successful. We need to limit change, and we need the orders on time. I'm going to build whatever they want me to build.
Trump's Golden Fleet may signal a shift to a larger Navy, but the real test will be whether America can build a fleet that's responsive and flexible enough for warfare that is constantly changing, all while staying the multi-year course that it takes for ships to go from blueprint to naval battlefield.
Up next, on Liberation Day in April last year, President Trump announced sweeping tariffs on imports from much of the rest of the world. Now, the Supreme Court says he has to give it all back. We look at how that is going. This is a story about putting Humpty Dumpty back together again. Small businesses were hit hard by the sweeping tariffs President Trump imposed under the International Emergency Economic Powers Act. So you'd think they breathed a big sigh of relief when the Supreme Court struck them down. But it turns out that getting a refund when you have overpaid is not as easy as it sounds, particularly when it's the government that has to pay you back.
One of the most significant cases that the justices have decided in recent years.
The Supreme Court dealing President Donald Trump a major blow.
The president does not have the authority to impose some of his sweeping global tariffs.
In April of last year, President Trump announced sweeping tariffs on imports from some 90 countries.
A historic executive order instituting reciprocal tariffs,
which hit businesses throughout the U.S. that had to pay the tariffs to bring in parts and goods. Victor Schwartz's VOS Selections is one of those businesses. What did the tariffs do to your business?
Well, it's terribly impactful. Out of the blue, we lost 15% of our cash flow. For any business, but certainly for a small business, that was terribly impactful. We had to make some quick decisions. One thing we had to look at is where could we raise prices to cover the tariffs? How much could we raise prices on which products? I tell you, we did not even begin to cover the tariff impact in terms of our price increases. So there was that. What kind of inventory we could jettison, because we had to come up with all this capital. Where's that going to come from? I don't have access to the credit markets, so where are we going to come up with that money? Well, we got to sell product off. And even worse is, think about it, it wasn't just about VOS selections. Everybody was in the same boat in my industry. So if everyone's trying to offload product, you've got a race to the bottom. I think we went through 4 different massive price changes over the course of the year. It was kind of head spinning. What was coming next? When was it coming? Not an easy situation, not a good place to be. And then the cherry on top is the fact that people are drinking less alcohol. So the wine and spirits industry is contracting all over the world. So nobody was happy.
We first met Schwartz exactly a year ago, just after he filed the original lawsuit in the U.S. Court of International Trade that challenged Trump's tariffs.
It's been a mess. It was 20%, then it was 10%, then they threatened 50%. In our industry, end of the day, we might make 5% as a net profit, 5 to 10%. So obviously, we can't afford 10%. We can't afford 20%, but 20% is really egregious.
Shortly after we last spoke, the Trump administration took Schwartz's case all the way to the Supreme Court. Earlier this year, it issued its ruling. So, Victor, a lot has happened since last we talked. You brought the case, you went to the Supreme Court, and you won.
We won.
But victory is a little more complicated than that. In the time that the tariffs were in effect, the Trump administration had collected $166 billion from more than 330,000 businesses, including big corporations like Walmart and Ford, but also many more small businesses selling anything from wine to women's bicycles, businesses that may not have the resources of large publicly traded companies.
We just want the Constitution to serve all Americans, and so we thought, why not us file this case? And nobody else was stepping up. Big businesses who have all the resources could have done it.
Sarah Albrecht is chairman and CEO of the Liberty Justice Center, which has been litigating on behalf of a handful of small businesses, including VOS Selections, that want their money back.
I think we had a strong case. I had hoped we'd win, but I knew the biggest battle was going to be after we left the courtroom and refunding the money to the thousands of small businesses across this country that basically had to hand over their entire working capital to the government while they sorted out this case.
So what did in fact happen? What was the process after it was remanded back down by the court?
We had to go back down to the Court of International Trade and kind of sort out how the process was going to go. And luckily, the Court of International Trade is a very specialized court that deals with exactly this type of situation. So they assigned us to a great judge, and we worked kind of a 3-way process between CBP, the government, and ourselves, and kind of came up with a game plan on how this was going to go. The judge was very much directing the process, and the government and CBP, I have to say, went along and did a good job kind of facilitating the largest refund in history. I mean, it was $166 billion, and just for a sense of what that means, CBP last year processed 338,000 entries. The IEEPA tariffs were going to involve processing 53 million entries. So they had to build out an entirely new system and portal to make it easy, because the last thing we wanted is small businesses to have to spend more time filing and doing paperwork and waiting for the government to give them the money that was rightfully theirs.
U.S. Customs and Border Protection has rolled out a 3-phase plan to return all that money. But as Albrecht expected, refunding tariffs is easier said than done. 5 months after the Supreme Court's rejection of IEEPA tariffs, the administration has returned only $71 billion of the $166 billion it collected. And now the Supreme Court has ruled, and there's a fair amount of money, according to press accounts, that has been refunded. of those tariffs. How much of that have you realized?
None.
Well, how does that work?
It's pretty frustrating, actually. So I have to contact my vendor, who is in turn waiting for a refund from the shipping company so that I can still pass through that refund to my customer as well. It's just really a big mess all the way around.
Allison Budvarzen is the COO of Out of the Box Manufacturing, a contract manufacturer of electronic devices that imports components from all around the world. Like many other small businesses, it is still waiting for its refund.
We get tariffs charged on raw materials that we use in our manufacturing process for machinery, as well as the component parts that we use to put circuit boards together. So we're actually getting hit from multiple angles.
Who pays the tariffs for you?
So it is a series of one person passing the cost down to another. Ultimately, my end customer is paying for the tariff. I purchase a part from my vendor, they pass the tariff along to me, and I pass it along to my customer.
Out of the Box Manufacturing is only one of many small businesses that use third-party shipping vendors like DHL and FedEx. Those vendors will receive refunds first before the money gets to the small business owners who ultimately paid the tariffs.
So the way it's set up, since they paid the IEEPA tariffs initially, then the refunds went to them as the importer of record on behalf of the plaintiffs and other small businesses. And so the refunds will flow to those third-party vendors, and then a second refund process from the vendors back to their ultimate clients and customers. And hopefully that is also a speedy process. We are just starting to enter that phase because the third-party vendors are just starting to get their refunds, and then they have to pass it on.
And even as some refunds begin to flow, the legal battle is not yet over. The cases you brought were specifically about the so-called IEEPA tariffs imposed under that statute, and the court said, no, you can't do that. The Trump administration pretty much immediately said, okay, fine, we have some other statutes we'd like to use. Where does that stand?
Yeah, literally 5 hours after we won, they announced the Section 122 tariffs. That was a tariff statute that also had never been used. Those tariffs started on February 24th. They will end on July 24th. So we filed a lawsuit against those illegal tariffs as well, and that was heard at the Court of International Trade. We won that lawsuit. The government appealed, and we're still waiting for our court date on the appeal. When the tariffs stop, that appeal will continue because we need to get that money back to not only our plaintiffs, but to every business who had to pay the Section 122 tariffs, which we believe were also illegally.
Albrecht and her team of lawyers say they will not stop until every small business gets its refund. But even if and when that happens, it doesn't mean that things will be restored to where they were before the tariffs were imposed. Business owners like Schwartz and Budvarzen say much of the damage has already been done, with unintended consequences that money alone cannot erase. What about now, going forward, putting aside for the moment what's already been paid? Has your business largely returned to where it was before the tariffs?
I want to say it's different. So prior to tariffs and prior to the expiration of R&D tax credits, we did a fair amount of work in R&D. That went away. I believe that the tariffs had the effect of slowing down the pace of innovation because there was so much waiting and unpredictability in components. So that really slowed that process down. The tariffs are not doing anything to move the supply chain in the way that they are intended to move the supply chain. The reason is that the tariffs simply aren't high enough to make it painful enough for behaviors to change. I'm not advocating for higher tariffs. What I would advocate for instead is predictability, stability, and then support to regrow those industries within the United States so that we're treating this problem with a carrot rather than a stick.
As a business person, I have to work here every single day in the market. I can't be waiting for things to happen through the courts, et cetera. And it's unfortunate. It has really contracted the market. It's something I said a year ago. I think I said it to you, and it's all come true. The market has contracted.
Coming up, it's all about AI these days. But is the rush to invest in the next new thing affecting what companies are doing on all the rest of their businesses? We talk with Blair Effron of Centerview Partners. Whether it's the stock market or the bond market or capital investing, it seems that there's only one answer to just about every question these days: artificial intelligence. Blair Effron of Centerview Partners spends his time advising corporate CEOs on deals and investing, going well beyond AI. We asked him, just how is the rush to AI distorting the rest of corporate finance? Blair, you spend a lot of time with big corporations and their CEOs. All the talk right now seems to be about artificial intelligence. How much is that distorting what's going on in the C-suite?
First of all, thanks for having me. David, I think it's distorting the markets much more than it is the C-suite. Okay, obviously the markets are all about AI, $700 billion worth of investment. At some point, investors will demand a return. And if you're worth $1 trillion and you trade at 30 times, that's $35 billion in net income you need. You pick the company that has that profile. Every time this happened before, the markets will get to the right place. There will be dislocation. Whether dislocation is upheaval or not, I don't know. What I do know is that CEOs are absolutely tuned to this. They are better at managing through these kinds of issues more than ever. And they look at AI from a business perspective as important. You would argue that AI investment is adding 30 basis points to 50 basis points of GDP growth, and it's helping companies. Now, it's not helping companies quite as deeply or broadly as people think. It takes a long time for a company to figure out how to use it as an appropriate tool. So I'm not one who thinks from a business perspective there's going to be a big cliff in employment. But it is on everybody's mind. The bigger question is the economy, and that's what CEOs always think about. And I think for the past 5 years or so, since COVID, most CEOs, if you talk to them in January about the year ahead, were always more optimistic than CBO would have been, IMF, Bloomberg, and they'd be right. I think that has shifted a bit most recently, and I think there's a level of caution that I haven't seen so much before. And I think most CEOs today think the economy is a 1.5% economy. They would have thought it was a 2 to 2.5% economy early in the year.
What has shifted? I mean, is that what they're seeing in their own numbers internally or more broadly?
Seeing in their own numbers. And you're seeing in some of the earnings that have been coming out. What shifted is the consumer. It is finally, I think, catching up with the consumer confidence index, that Michigan index that comes out every month, which is at all-time lows. The consumer was still spending. Now you have consumers really having gone through their savings built up when they weren't spending money during COVID, and becoming much more cautious. So I think how that settles out, I think, will be incredibly telling. And you combine that with energy price, and from my perspective, it's energy price as inputs for most of the products that a lot of our most important companies are using. And you can see where there's a bit of turbulence. All that said, turbulence that will be managed, and I do believe the economy remains incredibly resilient for all the reasons everybody's thought over the past several years. And I think that, when all said and done, will win the day.
Perhaps the most important job of a CEO is allocation of capital. And as the CEO looks at allocation of capital, put aside from the hyperscalers, they're in a different category. There is some hydraulic pressure to invest in AI for just about every company I can identify. How do they do enough so they don't get left behind without going too far and having something that, as you suggest, doesn't have the return that they need?
So first of all, it's a big difference if you have 5 companies spending $700 billion, 5 companies whose market cap together equals the GDP of China, second biggest country in the world, right? Most companies in the S&P 100 are making, actually even more broadly, are making appropriate investments in AI. They're spending more than they thought they would, but it's being implemented on a much slower basis. I think if you are not tech native, you're not yet using AI anywhere close to its full potential. That moderates how they make capital investment decisions. They know this, okay? So I think that if you look at the typical consumer company, they use AI exquisitely, but they're spending $1 billion, $3 billion, and $5 billion in capital. I'm talking about the biggest companies, the S&P 100, which is manageable. The bigger question is going to be, when can they actually become effective enough to realize the promise of AI? From where we are today, I don't see that.
In order to be able to make the capital investments, these companies have to come up with the cash, these hyperscalers. That has resulted in a lot of issuance, debt issuance and equity issuance. It's really record. We see it in the bank results right now, all the issuance going on. Is that crowding out at all what the corporations, other than the hyperscalers, can do?
Not yet. It is. There's a ton of liquidity. I am surprised that investors, particularly on the debt side, have been oversubscribing by multiples and willing to put money to work. The question of capital generally, I'd say one, very liquid, two, at cost, which is the key thing, that is still relative to where Fed funds are, I'd say reasonable. As soon as there is a turn in the hyperscalers, I think we'll have a very different conversation.
Centerview is global, it's not just U.S. One of the themes that we've seen with respect to tech, more generally, and certainly AI, is Europe versus the United States. Europe, perception has been left behind. We had the Draghi report. There are various initiatives going on. Are you seeing from your work evidence that Europe is in the move to catch up or at least get closer?
I do, but you use the word perception. It's a reality. The fact of the matter is 43 of the largest 50 companies in AI are U.S. based. Europe has one. Let's just talk about the market cap. They have one company, ASML, worth $800 billion. The next company is $350 billion. That is less than 10% the size of NVIDIA. They are, I don't believe, in a position to catch up. You look at the economies of Germany, of France, flat. You look at the interest cost of UK, too high. And the lack of coordination, I think, is a big issue. The fact is, the regulatory environment there, they're trying to do just what you said, the merger and acquisition environment, the rules are changing. They want to have more broad discussion as the regulator as to what's an issue, what's not, give them obviously some leeway there. And they look at the question of what is acceptable merger or not with a much different lens, okay? It hasn't changed, the numbers at all. M&A is 50% of the M&A market in the past 6 months has been U.S. driven, same level it was last year. So I think it's a long time before Europe realizes the promise of what they want to achieve.
Is it an even bigger problem for Europe not having a unified capital market? I mean, that's one advantage the United States has. It's one capital market. Over there, they have not been able to pull it together.
Not only do they not have one capital market, they don't have one view as to what kind of GDP growth and what kind of debt to GDP you have to subscribe to. There's exceptions every year. Italy makes the exception. Spain makes the exception. So they spend more time, I think, with, call it intra-family, back and forth, than they do focusing on the right thing. And I do think, as a place for intellectual capital, incredible. They don't let that intellectual capital be unharnessed in a way that the U.S. markets do.
One area of deal-making where Effron and his Centerview partners have been particularly active over the years is media, including as an advisor to both Paramount and Disney. One area, particularly in the United States, we've seen a lot of deals announced, at least, is something you know terribly well, which is media.
I do know a little bit about it.
with a combination of Fox and Roku going one way, I would say, toward integration, and on the other hand, you have Comcast spinning off NBCU going, it appears, the other way, separating distribution from content. Where are we headed here? Why is this all happening right now?
So first of all, it's happening because people are realizing that scale really matters in that sector. Why does it matter in that industry? Because they're fundamentally becoming technology companies. The technology companies are coming in, they've been in, whether it's an Apple, whether it's a Google, whether it's Amazon, and they're highly effective. So there has been, there were too many small companies. There are too many companies doing streaming, keeping down the margin. In fact, there was only 2 companies that showed double-digit margin. Netflix, 30%, Disney at 12%, and then everybody falls off a cliff. So what Comcast did is actually in line with that trend, because by separating a very mature distribution business from a vibrant content business, they will have more choice. I think in the case of News Corp, Fox, they recognize without some sort of way to reach consumers through streaming, they'd have a lot of problem. So I think they're making the right moves, but that's what's driving some of this consolidation. I will tell you, I think there is a highlighted concern, which has not been justified yet, that that AI is going to have a dramatic impact on employment levels. I see quite the opposite. And when you look at what happened with CGI, it opened the way for more employment. If I look at the question of AI and you're doing an animated film and you're spending $200 million to put it out, 500 million total, and you have 500 people working on it, and it takes 2 years, now you bring AI and it's 50 million to produce, it's 6 months to make, and it's with 50 people, you've just freed up a whole host of really smart, really creative people to increase content availability. And if you talk to the CEO of any of these companies, that's what you're hearing.
Does tech win? And by that I mean, if you look at the landscape right now, just in terms of amount of time spent viewing on screens, YouTube is just running away with it. Fast Netflix, they're just running away.
Absolutely phenomenal company.
It's a better mousetrap. In the end, do the tech companies win? And that doesn't necessarily mean buying the studios. You might not want to buy the studios, but they basically get to dictate the terms.
So I wouldn't say they win. I would say that if a content company doesn't become really tech native, they'd have a problem. I will also tell you, if you're a tech company, you don't actually understand quality content yet. Okay, you don't understand quality creativity. They know it. So the key for who is going to win is the company that can combine content with technology. If you look at what Disney's doing, making progress in that direction. If you look at what David Ellison is trying to do with Paramount, I say trying because we're not closed yet, it's all about the marriage of technology and content. So I think those companies actually are better positioned to get the two together than some of the bigger companies that don't have that creative DNA in their system, but they certainly know how to get out product and distribution.
Next, Blair Effron on the future of New York City and the Democratic Party. It's a summer of political change in the Democratic Party in the United States, led off by a Democratic socialist mayor taking the reins in New York City.
These New Yorkers voted for a new day for our city because the past one is clouded by housing insecurity and instability, where they cannot afford a life of dignity in the city that they love. Working people should be at the heart of it, and they're hungry for a politics that looks at the wealthiest city in the wealthiest country in the history of the world and understands that it's unacceptable that 1 in 4 are living in poverty.
Blair Effron knows both the city and the party well, so we asked him how it was going. We've had a change in the mayor in New York City.
I've noticed.
And there was a lot of concern in the business community leading up to Mayor Mamdani's election. He's been there a few months now, had some initiatives. Are we better off or worse off in New York City?
Well, let's talk about New York City first, then the mayor. New York City is firing on all cylinders. Our city that is no longer just finance. We are a huge tech hub. We're a huge hub for healthcare. The concerns around commercial real estate, we were all here a few years ago. You can't get office space. The amount of innovation that's coming to the city, intellectual capital, we're getting, depending on the statistic, anywhere 3 out of 100 kids or 7 out of 100 kids coming to New York upon graduation from college. So the city remains more robust than ever, and the jury's out on the mayor. There are things he said that I just disagree with fundamentally, and that is anyone in the city, and certainly any Democrat, we all see the problem. We all see that the economy isn't working for enough people. We all know what it costs for housing and its availability, energy, food, all issues. So the output we agree on, it's the inputs. And some of the inputs that are put out as policy concern me. The most important thing to me, and this is why the jury's out, is whether the mayor is the mayor who I saw give a phenomenal speech about the New York Knicks, granted, 53 years of suffering, but a phenomenal speech about New York, versus a 4th of July speech, which frankly I was disappointed, which was an opportunity to say, what is the greatness of this country, the greatness of this city, And his point about the American dream disappearing didn't make sense to me when I look at the fact that he was an immigrant, that he's in his early 30s, yet here he is mayor of the largest city in the country. That's the American dream, and that's what I wish he would talk about more.
So it's too soon to tell exactly.
Absolutely too soon to tell.
But he is perhaps an early indicator of a larger debate, even division within the Democratic Party that we're seeing play out right now in the primaries as we go into the midterms. Where is the Democratic Party right now, and where is it headed?
So where it is right now, I'm not sure that we have a definitive answer. I can give you a lot of data points on elections from last November that would point to a moderate party. Governor of Virginia, Governor of New Jersey. I can certainly give you a lot of data points more recently that would say that the highly progressive side of the party is winning out. It's not just New York, it's what went on in Colorado, what may go on in a House race in Missouri, what may go on in a governor's race in Wisconsin, what may go on in a Senate race in Michigan. That is going to lead to a intra-party squabble like we haven't seen. And I would also say you will see it more if the Democrats don't win by at least, call it 15 seats in November, enough to have Speaker Jeffries at that point, and he would be Speaker, push forward unified policy ideas. There will be, I think, deep headwinds going into 28. And when all said and done, I believe the country and the party are fundamentally moderate in terms of the inputs, again, what kind of policy they want. There is no disagreement among Democrats as to what the issues are. This question of affordability, you can call the word any word you want, excuse me. The fact of the matter is, most Americans working really hard simply don't have enough money to pay for what they need.
It's hard to put together moderate with it's not working for a lot of people. And that maybe is part of the issue here is a lot of people are saying, we want to change. We almost don't even care what the change is. We want to essentially blow it up. We want a big change.
And you saw that on the Republican side, you see it on the Democratic side, absolutely. And when I say a moderate, I mean moderate by position, not by goals. If that candidate doesn't have big, bold vision to really almost have a restart, he or she's simply not going to get elected. And I think that, frankly, it's high time we had a rethink of a lot of what we do. I think that certain Democratic candidates seem to be tapping into that. But I would also say it's going to be reflective of how different parts of the party look at business. I would argue that if you want to achieve this affordability question of how to make a big dent in it, you need business to do well. And I don't just mean the biggest businesses, I mean business across the spectrum. You need them to make more money so that they can hire more people and they can pay their people higher wage. It's not a hard formula, and that to me is what I think the party is underappreciating in terms of some of its us versus them approach.
Are you hearing voices, and it could be Democrats or Republicans, but you know the Democrats particularly well, who are stepping forward and saying we need fundamental change, and using capitalism, we could get some of that change. That could be a lever we could use, as opposed to it's something to resist or suppress or avoid?
So I have been very pleased with some of the potential candidates I've met so far, who almost to a person appreciate just what you said. And I think there is a realization that there's a reason this economy has been and will continue to be the strongest by far in the world. There's a reason why this is the first time when there's been a slowdown in other parts of the world, we haven't felt it as much. Any candidate would be wise to keep that in mind. Now, obviously, there'll be different levels of volume in what they say. I'm much more focused on what they're going to do. And I think we'll be seeing a different level of coordination than we have in the past.
It strikes me we've had this terrific conversation about the business climate, the United States and Europe, tech, media, things like that, without talking about Washington, D.C. And yet, if you look at the news on any given day, it's almost overwhelmingly related to Washington, D.C., whether it's foreign affairs in Iran or Crimea, or it's back here in the United States. Why is it there's a disconnect between what's happening in the business community on the one hand and what's happening in Washington, D.C. on the other?
So I don't think there is a disconnect. What I would tell you is most administrations, this one included, do all of their legislation, all of their work in the first year. There was no disconnect when the big, beautiful bill was put in place, and there was certainly no disconnect when we were talking about trade and protectionism. So you saw a lot of reaction. Go back to that famous April 2nd. A lot of reaction. The fact of the matter is, since then, the uncertainty is what's said, not in what's done. And CEOs, as I've been saying for a while, are just really talented at managing through that uncertainty. So I would argue that in some of these companies, they're actually city-states. If you are a $4 trillion company, which, to put in perspective, is 10 times the average of the top 10 companies when we had the great financial crisis, you have a lot of sway. And I think you're seeing that routinely. So the bigger question to me is, as you start to think what the next big policy objective is going to be in Washington, well, it's all going to depend on whether you have a Senate, a House, and a presidency that are all aligned.
That does it for us here at Wall Street Week. I'm David Weston. See you next week for more stories of capitalism.